This is the market forecast for Monday, July 17, 2023. It's actually a big picture update, but if you haven't seen the last one, don't worry about it. We're just going to do a quick recap of what I covered last time before getting started. So this was roughly the model I introduced, which shows that during the COVID sort of money printing, you saw inflation tick up, and as a result, the economy boomed. What happened here was that the government started handing out money, causing demand for products and services to accelerate. And then when manufacturing tried to catch up to this excess demand, what they needed was to hire people to then manufacture things. So in this sort of situation, what you have is basically the government handing people money and then employers handing people money. What are those people going to do when they have a lot of money? They're going to buy stuff. And that is why inflation is staying elevated, is because people have money, people have employment, which is why they have money. So the Fed's number one concern right now is to bring down employment. Because if people are unemployed, they're not going to be spending. And if they're not spending, it's going to force prices to come back down to earth. As a result, what we're seeing right now is, again, the Fed has raised interest rates like crazy. And we're at this point right now where interest rates have been elevated for a little while. And the Fed is getting kind of worried. They're getting concerned because they don't know if the economy is going to slowly come back down to earth, or if it's going to be a sharp, sort of unnatural deceleration in the economy. This is not what the Fed wants to see, because it's going to be hard for them to contain this. What this actually means, by the way, is unemployment is rising, and it's rising at a very, very fast pace. People are just getting laid off in mass, and again, that's not what the Fed wants to see. They want to see a very orderly sort of deceleration in the economy. People are getting laid off gradually. It's slow so that it can be controlled. That's the whole point of this. They want to be able to control the slowdown. Now, getting into the economic data and what's actually been going on recently. So in recent weeks, what you're seeing is that continuing unemployment claims have, in a sense, sort of just been moving sideways, but they've had a downward slope, which means it's not taking people too long to get a job after they've been laid off. So even after people are getting laid off, it's very easy for them to find employment. And as long as the job market remains strong, inflation is going to remain elevated. And that's a problem. So again, the number one concern for the Fed is to close this gap between the number of job openings that are out there and the number of people that are unemployed that can then fill those job openings. And in my opinion, based on every market cycle that we've ever seen, this problem cannot be solved unless the Fed pushes us into a recession. And a recession, again, it's not going to be a very orderly sort of decline. It's not going to be a very sharp decline, but a recession ideally would be something in the middle, which is something, it's controlled, but unemployment is really ticking up and people are losing their jobs. So that's the goal. That's what the Fed is trying to do right now. And the economy, again, remains resilient. So that's not really happening. So basically, the Fed is failing at their job at the moment. So what have we seen in recent weeks? So last week, CPI data came out, and CPI, if you've been following it, it's been moving lower for basically the whole year. And even though it's been moving lower, in recent weeks, or really last week, the data started to accelerate to the downside. And all this is happening while employment remains really strong. So what does that mean? That means that the Fed might be able to get the economy to slow down in the most ideal fashion, which means they get to avoid a recession and they get to create a scenario where inflation comes down without people losing their jobs in mass. In all the economic cycles that we've been through, to get inflation under control, they need to at some point create a recession, not because they want to, but because they have to. So for now, interest rates remain elevated. They think right now that the market is just going to come back to earth on its own without causing recession, but I don't think this is the most likely case. Where I think, if let's look at this chart. So if this is, let's say, the inflation cycle, I think we're roughly here. And just like any cycle, you don't have clean movements. What you have is ebbing and flowing around the mean, which is what I've shown right here. And what I think is happening right now is that we're somewhere like around maybe here, where you've seen some kind of a sharp deceleration in price, and hence everyone thinks we're going to avoid a recession. But until people lose jobs and they get to a point where they're not really willing to spend money and demand really starts to come back down to earth, until that happens, the Fed's going to keep hiking interest rates. They're going to keep them higher for longer. And so we're not going to end up in a scenario, in my opinion, where we end up with a soft landing. I think we very likely will end up in a recession. But for now, everyone's expecting a soft landing. And eventually, I believe the inflation data over the coming weeks, over the summer really, going into the fall, you're going to find inflation, it's going to continue to cool, and then it's going to plateau. It's going to stop coming down. CPI is going to surprise to the upside, and as it starts to tick higher, it's going to cause the Fed to really ramp up their the degree to which they raise interest rates. So what's the point of everything that I just said? This is everything that I think is going on in the economy. Well, what does this mean in terms of markets? So looking at the charts, we've seen that bond yields have really pushed lower. I think there's a good chance they're going to continue to move sideways, maybe a little lower for now, but eventually as inflation starts to firm up, you're going to see bond yields push higher. I don't know when that's going to happen, but I believe it'll be sometime over the summer. The dollar has fallen out of the sky because, again, if the economy is slowing down on its own, why would the Fed need to raise interest rates, right? Well, the dollar relative to the euro, relative to the British pound, you have a situation where the pound and the euro are accelerating against the dollar because both of those economies, they're going to be raising interest rates, and they've publicly stated this. So we're seeing a ton of weakness in the US dollar as a result. All these flows are pretty much, you're seeing assets flow out of the dollar and into the euro and into the pound. So for now, I expect this thing to kind of slow down, maybe even pull back a little and then continue lower. There's a good chance that'll happen. The oil market is just an ugly market. I really am not interested in this at all. I'm just kind of keeping an eye on it because it's just something that interests me. But in terms of trading, it's not something I'm interested in. When it comes to the stock market, the S&P, it's really interesting here that it is starting to lose momentum. But as long as this notion that the economy is going to slow down on its own, the Fed doesn't need to push us into recession, as long as that remains credible, you're going to see the stock market make new highs. Because as long as we can avoid a recession, people can keep spending money, and these companies can keep making a profit. So the market that I care about, the market that I trade the most, is gold. And what you're seeing right now in gold is, even though the US dollar has fallen out of the sky, you're seeing some strength in gold, but really not that much. And I would suspect that if, again, inflation's coming down and stocks are really looking attractive, people that have, fund managers that have been in gold for some time would, again, near almost $2,000 an ounce. This thing is still close to all-time highs. they're going to want to book profit on gold and move some of that profit into stocks. So for that reason, I'm looking to short this thing. There is a contract expiring on July 25th. There's also a potential interest rate hike the very next day. I don't think that gold's going to rally all the way into, this fundamental event or this combination of fundamental events. I think that gold's going to rally. It's going to, get people interested in chasing the rally because, again, we're very close to the all-time high still. And I'm thinking by late this week, possibly Thursday to Friday, somewhere around here, I think it's going to top out. It's for now. I like the pattern that we're getting. I want to see this thing ebb and flow a little bit more. I'd like to see it come down here, maybe hit the trend line, maybe head higher. For now, I'm just keeping an eye on it. I just want to get a better picture of where it's headed. So I will be looking for shorts later on. This is the general game plan, where I was expecting gold to rally last week. This week, they're going to start booking gains and getting out of this market ahead of the contract expiry. And then the real sell-off will be, I think, Sunday market open and most of next week, going into the rate hike. I'm sorry if this was a little bit rambly. I'm just getting used to recording these videos. But if you have any questions, just go to the chat and drop your questions, and I'll answer them whenever I get a chance. And that's it for today's forecast. Until next time, cheers.